A wonderful introduction, and we thank Kerry. She organises, as always, a wonderful gold event. Thank you very much. It was great to see our colleague from the Perth Mint tell you that it's not a better time to go gold, and I certainly 100% agree. And a good old friend of mine, Tony Howland Rose, I saw on the way in, he says so as well, and if he says so, definitely it's right. So we're going to run through the ASX resource market. We're going to look at it generally, and then we're going to look at it specifically at gold. Where's it at? The ASX, Austex, as Kerry said, we cover all ASX resource companies. We got down to... Oh, sorry. Yeah. We got down to as low as 726 in the third quarter of 2020, and since then, the ASX resource market has grown by 19% companies due largely to new listings, to where we currently have 860 companies on the ASX focused in the resource sector. If we look at the average share price of those companies over the last 4 years, the average share price rose 58% over the 3 years to July 2021 to hit a market peak in July, and since then it's fallen 11% since then to the end of May. So the market is retreating, as you know, and a lot of reasons why, and that's why gold looks like it could be something that we can look at seriously. The sector has rose, if we look just this year to date, 2022, it rose 16% from the 1st of January to the 15th of April, and since then the average share price of all those 860 companies has fallen back to be 1% now lower than at the start of the year. Comparing gold stocks with the other high flyer of the last 12 months, Lithium, as you know, or the high flyer of the last 12 months, lithium stocks on average are worth twice what the gold stocks are. As you can see, the green line is up around 100 cents per share on average, and the gold stocks are down around 50. The lithium stocks are down 10% now since the start of 2022. There's a lot of talk around about oversupply, and since then it's come down 29%. So it has come down sharper than the gold stocks. The gold stocks are holding up a little better than lithium stocks at the moment. They peaked on the 14th of April for this year, and since then have dropped down 19%. As I mentioned, the market has grown through a whole lot of new listings. That's a graph of new IPOs, which have grown 18% from August 2020. That's the number of companies by way of new listing. The maximum listing per month peaked in July 2021, obviously when that coincident with the market peak, and since then has fallen back a little bit, but there still seems to be an appetite. IPOs still seem to be doing very, very well in a lot of commodities, provided they've got a good project. But if we look at why they're, when you look at the share price performance, they're not doing so well. If we look at those that have listed in 2022 and have been on the market more than 3 months, and we highlight the gold ones in yellow, we see that all IPOs has only been 0.55 rises for every 4, and for gold only 0.2 rises for every 4. So it's basically that there's a little machine going there where promoters and punters are putting the money together, probably institutional money, maybe your super money, and they've been buying and setting up these companies and making huge fees out of it. So, if you go into an IPO, you can make sure it's a good company. There's a couple there, like Felix, in the 3-month plus ones, that should be doing a lot better than it is. On the 1 month ago, companies have only been around 1 to 3 months. All IPOs, 0.46 rises to a fall, and gold, no rises to any fall. And you can see the gold stocks again on that right-hand table, again highlighted in gold. Most of them down, including many peaks. There's been an absolute failure, down 40% since it listed between 1 and 3 months ago. So probably not the time now to get into IPOs unless you're on the fee receiving end. Capital raisings. It's amazing how well the ASX resource companies have done in raising capital. Now, every 3 months out comes a report that every CFO has to put out called the Appendix 5B Cash Flow Report, and we analyse all that. Now, that 88% of the ASX resource sector have to put that out. They're all the explorers and some of the more recent producers. So bigger producers like BHP, Rio, etc., they're all exempt. They don't put this out. So 88% of the market's in these figures. So the total cash raised quarter on quarter was around, by these companies, was around 700 to 800 million pre-COVID. It dropped down to as low as 505 million in the first quarter 2020, and if you can recall back in history, that's when the outbreak started. From second quarter of 2020, as we all were stuck inside, we couldn't go to the west and the west couldn't come east and all the rest of it, the cash raise rose gradually to reach a peak of over $3 billion in the fourth quarter of 2021. That's the little resource companies on the ASX, as people ploughed in, put their money in and supported the companies. In the first quarter of 2022, it fell to 1.5 billion, but it's still well above the COVID quarterly averages. It is coming back to the more normal averages, but it's still very, very positive. So there's a lot of money going into the resources sector, which is great to see. What it means to the little companies, the over $1 billion capital raisings has helped resource companies increase the average cash held by 37%. So gradually, up to the third quarter of 2021, they rose to average $11.1 million on average per explorer. And since then, they've remained pretty level. But if you look at the orange lines, in that time, the companies have been able to reduce their debt. So it's companies are well cashed up to do exploration and develop projects. If we look at the total capital raisings of gold companies compared to all those, we see that the gold companies have raised less on average over the last 6 quarters than the percentage of the ASX market they represent. If you look at the last quarter, for example, the first quarter of 2022, gold companies raised only 25% of the cash raised by the explorers, and they represent 37.8% of the market. So gold companies are not raising as much. That's because so much money went into battery minerals. And maybe the chickens now are coming home to roost, and we'll see more of a move back into gold. One of the things we also look at is the number of announcements we do. We look at each month and go into the Austex report. In the blue columns there, we see that the average capital raising announcements that have been made have fallen from October 2020, when there were a lot of talk about capital raisings, by 50%, despite peak capital raisings occurring 12 months later. So it is coming off, and it's continuing to come off. So capital is getting harder for explorers to find. Obviously, with inflation kicking in, it's going to even get worse. On the other side, coincident with the bigger capital raisings, there's also been more money going to exploration. So we've seen a rise up to the fourth quarter of 21, when nearly $1 billion went into exploration. And it dropped down, as it always does, in the first quarter of 2022. The reason for that is the seasonal. Not so many companies are out in the field, particularly in the northern parts of Australia. Exploration expenditure was less, but it's still, in the first quarter of 2022, was still 54%. So still a lot of exploration out there, a lot of drill rigs turning, a lot of results coming up, a lot for investors to churn through every day. And that's why we try to help them. The total expenditure by gold companies over the last 6 months, as compared to the rest of the market, is gold exploration companies have mostly outperformed. So gold companies have raised less money, but they've spent more, which is great to see. So maybe not so many lifestyle companies among the gold companies. A recent exception is in the first quarter of 2022, as we saw some of the small golds in Western Australia have a go at lithium and rare earths and other things that were the talk of Biden's and the others at that particular time. Drill intersections announcements over the years that we cover, they have been building up. They average at the moment about 150 per month, so our readers are seeing 150 summaries of announcements on drilling results on average. So they're still building up, and they are averaging 171 per month in 2022. So the activity, the exploration is growing. The weekly project announcements, so if we just look at this year, it is dropping back. It has fallen 15% as the market starts to slow up and less activity is going on out in the field. So whilst it's gone up over the last several years, it has been dipping back in this last 6 months. So ASX companies, gold obviously, that makes up 36% of the market. A number of companies with its flagship projects in gold has risen 39%, and rises have also occurred in copper explorers, nickels, PGEs, iron ore, rare earths, zincs, leads, fertilisers, kaolins and silica. And lithium companies have stayed about where they were in 2018. So they're all the different commodities that we cover in the Austex report, not just gold. The average change of share price over the last 12 months by commodity, gold has actually fallen over 12 months of the average gold share price, and that's in line with the fact that the Australian dollar gold in that table on the right-hand side has only gone up 11%, and on US dollars only up 1% over the last 12 months. In compared to lithium carbonate, for example, which is up, the price of lithium carbonate has risen over 400%. So that's why the lithium stocks have risen on average over 150%. Coal stocks, obviously, that they're going very well, over 100% as the global demand for coal increases. Fertilisers over 50% as that's largely due to the Ukraine war, with they produce a lot of fertilisers, and also Russian gas. People don't realise how most fertilisers are actually the product of gas, and so forth. So dividing the market up into 4 quartiles, gold-focused companies only represent the 17% of the first quartile, of the first 25%, so we're underweight in our bigger companies, those with a market cap over 104 million. But if we go down to the 4th quartile, which are companies with a market cap of less than 12 million, we are 30% of that quartile, so we are punching above our weight there. So that table shows you that we have a lot more smaller companies exploring than we do have bigger companies producing compared to the rest of the market. Price ranges though, first quartile golds, those with a market cap over 100%, over 100 million have gone up over 30% in the last this is year to date, which is great because the market's gone down 1%, but our big golds have gone up 30%. So they are moving up. The early money's getting in, the smart money's getting in. And that's compared to all companies in the first quartile going up 20%. And the 4th quartile is much the same as the average for the whole market. Where do our gold companies work? Well, 75% of our ASX listed gold companies are active in Australia, and 54% are active in Western Australia. So there's a big bias of gold companies to Western Australia. That's a good reason for it. The geology's right. There's plants every 10 kilometres down the road. There's somewhere to process. It's easy to explore, and it's a great little business. And of course, it works very well. New South Wales follows with Queensland. Internationally, the Americas have 37 companies active there on gold, with the dominance in Canada and the US. In Africa, Cote d'Ivoire heads the list with 5 companies. That West African belt of Cote d'Ivoire, Mali, Ghana, and Guinea and Senegal is particularly prospective for gold. It's one of the world's best areas. Elsewhere, New Zealand has some interesting gold. If we look now at the first quartile producers listed in increasing all-in sustainable costs for the first quarter of 2022, and we list them in order. You can see that little graph, and if you send me an email later, I'll send it to you and you can work your way through it. But the average internal costs that big companies are suffering at the moment, or incurring is a better word, is just over $1,500 an ounce Australian. So we need a minimum Australian gold price of $1,500 for these companies to meet their operating costs. And it's up 1.3% on the last. We expect it to go higher because of inflation. It's hard to get, having to pay more for staff, having to pay more for services and goods. If we look at them in a different way now, if we look at their market cap per reserve ounce, we see that the average there is $578. This is the average dollar that the market cap. It's the market cap that the market puts on the average gold company, which is 22% of the current gold price. So if you want to buy a mining company, you might be looking at an average, if they've got reserves, of about just over $500 an ounce. If you look at the blue column on the right-hand side, it gives the mean group resource lives over 10 years. Newcrest comes out on top with, in their reserves, they've got 18 years of production on their current operations. Again, send me an email and I'll send you a copy. The emerging gold companies in the first quartile, these are companies with market caps over 100 million. There's quite a few of them coming out. Tulla is the cheapest market cap per ounce. That's because they're hanging on to Pantoro's development of the Norseman goldfield in WA. Kingsgate looks like it's going to revamp and get Thailand going again, Chartree. Tito in Côte d'Ivoire is building a plant at the moment. Red 5 have just kicked King of the Hills off, KOTH, and Calidus, who are presenting here at Warrawonga, also is a recent producer. Bellevue have started to move into it, and Catalyst also are here. They're in production down in Tasmania. So the average of those companies is $509 a reserve ounce, so they're a little bit cheaper than the bigger guys, or the ones in production, but their resource ounces average is about $182 per ounce. So keep those in mind when you're doing your own due diligence on any investment you might like to do in the sector. The first quartile gold explorers, those with the ones with over 500,000 ounces of gold or more, are listed there. Novo is very cheap up in Alaska because it's very low grade. It's only 0.3, so they have a market cap per ounce only of $12. But most of the WA guys are looking there. The Ausgolds, the Antippa, the De Greys, the Musgraves have a resource ounce of just around about $100 an ounce. Other explorers are down the bottom who have big market caps, but not necessarily resources over 500,000 ounces. One to point out is Magnetic, who drill and drill and drill and drill, but don't come up with a resource. They've got some fantastic drill results, but no resource. The second quartile companies, so these are companies that are between $32 and $100 million with a resource, and I think we've got that at over half. No, there's some smaller ones there. Anyway, the average price per resource ounce for these companies was $88. So that compares to $98 if you're a first quartile company with more than 500,000 ounces, and $182 million an ounce for emerging producers. So you can see how the value of that ounce in the ground grows as it's closer to becoming a producer. If you're in production, big operation, 182. If you're a bigger company with $500,000 ounces or more, 98 on average. And then if you're a smaller company with your ounces, 88. So that's one way of looking at when you do your due diligence on gold stocks. So this is the typical share price appreciation curves as a project goes from grassroots to production. The stages along the way: early drilling opportunity, company takes out an exploration licence, on the ground floor, does some geology, does some geophysics, does some geochemistry to get some drill targets, then starts to drill and starts to get some good results, and the share price starts to pick up. And we call that the exploration sweet spot. This is where you make the most money. I haven't talked about those sectors yet, and that's because They're harder to find, they're harder to pick, and a lot of it is, if you're going to win on those, you've got to have some inside information. And then you get some results, and you get up to, when they've got some good drilling results, they'll start to put a resource together, a reserve, and start feasibility studies. Is this project worth developing? Then you go through this dip, and this is this bloody big long period of time we have in every state government of permitting and finance. It's not as great as gold as it is in coal. I can tell you up in Queensland we've got coal companies are waiting more than 12 bloody years for governments to get off their backsides, but for gold it's a lot better, particularly in places like WA, and New South Wales is good as well. But you wait that long period of time, the market loses interest, so you know, when it might be a time to look at taking a profit when they're at the feasibility stage for a while, because nothing's going to happen probably for a little while. Then they start construction, and then they start to meet, at the end of the day, meet their targets, meet their revenues and meet their cost targets right on the top floor. So how do we deal with this in an Austex report? Well, we divide our report up based on those sectors, from new dealings, in Section A, that's a new project, right through to production at the end. And the sweet spots that a lot of investors are looking at every day are the drill intersections in Section E of our report, the drilling in progress. This is where you might pick one up in Section F, and also in targeting exploration. And you're not alone. Every ASX major resource company is a subscriber to Austex. So the big companies are there looking, and the big overseas companies as well, at what we're saying every day about the various projects as they're going through their drilling. This is what our index looks like every day. There's always something there in that EC Goldilocks zone. So EF Goldilocks zone. This is one from a few days ago. And you can see all the green ones I've highlighted are in the drilling in progress. So quite a bit of due diligence every day if you're a subscriber to follow up on all those and see what you think. And the ones in orange are drill intersections in that particular day. The index has not only the section of the report they're in, but also the commodity they deal with, and also how the share price changed over the day. This is a snapshot of part of the internal part of the report, where we're actually providing a summary. There it is, technical. So you have to understand a little bit about geology, mining, metallurgy and so forth to get the full value out of that, but you can read the full announcements by clicking on that link below each of those particular summaries. So that's in the body of the report. And Section F, as I mentioned, is a section for speculators. So we did a case history, it was a little while ago, it was back in March 2021, where we looked at 23 companies that made Section F, that's drilling program announcements in that particular month. And we charted their average share price from the time of that announcement. They're all made in that first week of March, actually. And you can see straight away the share price, average share price starts to climb, up 21% over 6 to 8 weeks. And then the market loses interest, and it's down. So by the time the drilling and the results come out, your price appreciation's gone. So you've got to write them up, but you've got to get in early to be able to do that if you're going to speculate on Section F. But that's where you make your most money. We do some comments as well. Each day in each report we have some standouts. We're looking at things like Strandline, who are on time, on budget with their development. Strike, who have made the smart move of buying a lot of land around where they're planning to do some gas development, also build a urea plant. Lion, over in Fiji, with some high-grade gold intersections, and Essential with some pretty good lithium ones. And then we give a summary of some of the others as we go down through the list there. So that's basically what we do. We provide the service. Most of our readers are resource company management and professional staff, resource-focused capital markets professionals, service consulting professionals and industry contractors, and resource-focused investors. So if you're a serious resource-focused investor, this is for you. If you're a mum and a dad that casually gets in this is not for you. You can talk to me for trials and subscriptions. So there's my email there, rob@austexresources.com. Wish you a wonderful and successful conference, and thanks again to Kerry for the opportunity to talk to you.
Thanks, Rob. Stay there. I've asked him to stay there because he's got a couple of minutes left over, and I know that there's people out there that might want to ask Rob a question. There's a lot of information that he has given to you. Have we got any questions? I can see Keith there. Not you, Keith. You know all about this. Any questions from our newbies in the audience? And don't be frightened of asking questions. Also, okay. Have we got a microphone, please? Have we got a handheld? Sorry, guys. Just gentlemen, just here. I will get a volunteer next time to do this. Mike's just coming to you now. Here we go.
Thank you. Oh, look, my question is, it's to do with why don't the mining companies get together and sort of form a conglomerate to try and take on the COMEX and the LBMA to bust them, to allow gold and silver to reach their true market value?
Whoa, that's a half. Yeah, okay.
I think you're the wrong guy. I'm just a simple geologist.
Yeah, he's a geologist.
No, but you guys are sort of doing yourselves a disservice, because if the precious metals were basically allowed to trade as a true open commodity, then the mining industry prices would be much better than what they are, and the profitability of the mines would go up significantly.
Yeah, I mean, what you say is right, but the problem is, I mean, I don't think we're that well organised. And we work in different jurisdictions.
Correct.
So, every state runs its own mining act, every country runs its own mining act, and an exploration act, so they're all different everywhere. And I think we're just busy getting on with the day of going out there exploring, finding some gold and getting it into production and whipping it off to the Perth Mint. But, it's very hard to, we really can't manipulate. I don't think any commodity can manipulate the market.
So any commodity can't?
No. So what Rob's saying is that the mining companies themselves, I mean, I understand what you're saying. Can they all get together and start to blow this out of the water? But unfortunately, what you've got is what Rob said quite clearly, is the mining companies, first of all, they've got a lot on their plate anyway, number one. Number two, they do work in so many different jurisdictions with different rules and regulations. And quite frankly, they spend so much of their time working through all the red tape and all the challenges from whether it's state or federal, whichever country they're in, and all those challenges. I mean, I can't tell you how much I speak to mining companies that have to deal with the paperwork just to get them through to the point where they can get further down the line. So I understand what you're saying, but these poor buggers have got so much on their plate right now that trying to do what you're saying is just... Wouldn't happen. I don't think it would happen. I think we've got another question.
Competition.
Yeah. Another question just behind here. Thank you.
Rob, thanks. That was fantastic as always. I'm being specific here. You mentioned Felix Gold as being one to watch. Would you like to elaborate on that, please?
As always.
Go and talk to Catalyst. They're their next door neighbours. No, look, it's a good company. It's down in central Victoria, north of Fosterville, and I think they've got some... Oh, hang on. Have I got the wrong company, have I?
Alaska.
Oh, sorry. No, I've got the wrong company. Take that away. No. I'm thinking of the one they listed down in...
Oh, you're
spun out of Chalice.
It's spun out of Catalyst, you mean, or...
Chalice.
Yeah.
Chalice, sorry, Chalice.
You're thinking of Falcon.
All right.
Yeah.
I had the wrong one. Take it back.
All right.
All right,
Look,
thanks for pulling that up.
Rob will be around, won't you, for the rest of today. So if you see him, go and ask him some questions. We're running out of time now. We're going to go into our mining companies now, which is a nice segue. But Rob, thank you so much. Really, really good way of opening up to the conference. Thank you.
Can I leave you with one thought in buying gold?
Go back to the...
One thought, I'll leave you with one thing in buying gold. The harder the world pushes for zero emissions, the greater the inflation will be and the bigger the story for gold.
Well said, Rob. Whoa. Do you know what? I couldn't have put it any better. The harder they fight for zero emissions, the better the case for gold. And quite frank, I was speaking with Rick Rule recently, who said right now he is as excited as he has ever been about the case for gold. You need to sit up and you need to understand what is happening globally, not just with inflation, but as Rob rightly said, this push for zero emissions. You guys are sitting in the right place. There are so many opportunities for you right now, and that debasement of paper money is going to continue, and those printing presses will continue to we have to be aware of where gold sits. And I'm not suggesting you sell your house and your children, but you should have some allocation to precious metals. All right, let's get on with our next one. I'm pretty excited about, we're going to have